The types of loans, though, that are putting permanent money out there, credit unions. And I think you'd be interested to note, credit unions are a valuable source of funding. Very valuable, and they have been. They've always been conservative, but now the conservative lenders are the ones that are still around. They're a valuable source of financing. One of the things you're not going to be able to negotiate on it is the R word, recourse. I like to see everybody's reaction when I say that. Fannie, Freddie, FHA, non-recourse loans. Credit unions, commercial banks, typically recourse. Conduits, non-recourse. When you hear the word recourse or non-recourse, one of the things to keep in mind is even though you are buying it through a corporation and you form a special purpose entity to own this to own this property, you are still going to be a guarantor on that. A key principle of a transaction is going to sign on the note and sign on behalf of that company. And Fannie Mae, Freddie Mac, and conduits have what's called carve-outs. Carve-outs are certain circumstances where that lender can chase you personally. Now, if it's market conditions and you've done everything you can do and you say, look, this just isn't working, but I'm right here talking to you, full disclosure, it didn't work, that wouldn't trigger the carve-outs. But if you've been taking money from the local waste management company so they can dump some stuff on the property and your value tanked and you walked away from it, they might be able to come after you personally. If you just walked away, negligence, that's a scenario where they can come after you personally. So those are the carve-outs that you're going to sign on. The FHA loan that we talked about is that does not have carve-outs. That's actually true non-recourse. So that's another added bonus to that, is it's the FHA's true non-recourse, no carve-outs. When you're borrowing from an insurance companies are more boutique lenders. They're putting their own money out there, putting their own funds out. They usually don't like to go over 65%. Rates are good. Rates are in the fours. Fixed periods anywhere. The mainstream is going to be a 5-year fixed period because, again, like the bridge lenders, they want to get the money back. They want to make those fees again. But that's generally the range for the insurance companies. And the recourse, the non-recourse can go either way for the insurance companies and their portfolio products. It really depends. I've got insurance companies that have special programs just for discounted payoffs, higher risk stuff where they'll negotiate the discounted payoff for you and split the difference. I mean, real creative stuff. And I've also got insurance companies that will only work with certain amount of brokers. They're extremely structured and they've just got a very cut and dry 65% 5-year fixed plan. If you want it, come and get it. That kind of thing. So it's every end of the spectrum when you're dealing with the portfolio lenders like that. You would use a perm loan, and this is going to be very basic for everybody, but it is something that I want to address. When you're negotiating on a property that is stabilized, when you're buying a property for the long term, and the value in your purchase price is not there to incur the expenses from a bridge loan, that's when you do perm right away. That's when you do perm right away. Because remember, when you go into that bridge, that bridge structure for the unstabilized property, you're not going to see that cash-on-cash return to your investors the first year, typically. Some of you hotshots might, I don't know. But usually you're not going to see that property throw off the cash-on-cash the first year like that. So it's going to take a little time to season. This permanent loan, when you go straight into 75-80% financing, lower closing costs, you're going to get my lenders give me the money at par. I have a 1% fee, and then your expense deposits are anywhere from $4,500 to $25,000. And there's probably some questions on what that includes and what the differences are. Is that par? I'm sorry. Yes. When rates are structured interest rates are structured in a certain way, and it can vary depending on the fee structure that you pay in the beginning. So if you pay no lender fee, or there's 0 points. That's the language that you guys would understand. No points in the front, and you pay X rate, that's par. That's a par rate. You may be able to pay a point up front and drop that rate, the interest rate, by 0.25%. Typically, some lenders would say if you want to put the broker fee in the rate, charge X amount higher interest rate. They might offer that as well. But when there's no lender fee, and I say it's par. It's a par rate. Well, the rate, if you pay a percent at closing, then your rate should go lower. It's going to be, because once again, now we're getting back into the minimum yield or the yield to the lender. It's going to maintain, so they play that yield game. But stabilized properties, long-term holds, that's when you're going to use permanent financing. We talked a little bit about FHA loans and the type of structures they offer. When you're going straight into permanent financing, Fannie is probably the best blend of what's out there for multifamily loans. A Fannie Mae loan, it encompasses all of your hot buttons. It encompasses it offers a long amortization, 30 years. Gives you a wide choice of terms, fixed periods. You could do a variable. You could have a 7-year term that floats, and you could lock it in any time in the first 2 years. You do that. You could do 3-year fixed. You do 5-year fixed, 7-year, 10-year, all the way up to 30-year. The sweet spot right now, where most people are locking it in, if it's a buy and hold straight away, it's anywhere from 7 to 10 years. And you're seeing, I mentioned it before, you're seeing the 7-year money go out in the high 3s, and you're seeing the 10-year money go out and fix at the low 4s, 4.1, 4.3, something in those ranges. Fannie Mae loans are assumable as well. It's a 1% assumption fee. So if in year 3 you decide that the prepayment penalty is too onerous and rates have not gone up substantially and it's just going to cost way too much for you to defease the loan and to sell it, you can assume it. It's important to note, too, that no subordinate financing is allowed on a Fannie Mae loan. They do not allow for a seller second. And I get that question a lot. And I know Sue's all about the creative financing and working with the sellers and making that work. They don't allow subordination. They don't allow seller seconds. So I have seen sellers maintain a certain portion of equity in the property. That's not debt. That's preferred equity. And the two key buttons to focus on there are no defined payout. Okay, so if you don't say, hey, you've got a preferred equity piece, but we're going to buy it from you in 3 years for X amount of money, and we're going to give you X amount of dollars every month. That's just a second mortgage in sheep's clothing. So I mean, if it looks like debt, they're going to call you on it. But if there's no guaranteed payments, it's just a percentage of the equity, just like a normal preferred equity piece would be. And there's no defined buyout, but maybe there's a window. Maybe there's an option period in 3 years where the key principals have the option to buy that. That is where preferred equity can be a valuable tool. All that being said, they don't allow for subordination. What they do allow is what's called a supplemental loan that Fannie Mae offers. It's got to be a minimum of $1 million, and you can only do it once in any 12-month period. But in the case of an assumption, somebody can come in, assume that note, place a supplemental loan on top, and the rates are not what your normal subordinate financing, what your normal second mortgages are. Rates are much better. They're usually maybe 10 bips over where you would normally close the first mortgage, 10 basis points. So 4.5, 4.6, 4.4, something along those lines on a supplemental loan. Now you've got a nice deal for the borrower. They're taking over your existing note, which has however many months left on it, at today's rates when you closed. and it's 3 years later. So does anybody think rates are going to be higher in 3 years? Not as confident than the 7, huh? Think of how I feel when everybody calls me and says, "Where are rates going?" So anyway, those are just some structures that they offer. Yes, sir.